Two single people living together can each deduct up to $400 in state and local taxes. That is over $80,000 combined. But the second those two people get married, their combined deduction drops to $40,400. Same house, same jobs, same taxes paid, but half the deduction. The IRS literally rewards you for not getting married. And that is just one of the ways the tax code punishes two-income households for doing exactly what everyone told them to do. My name is Nick, and I have spent an embarrassing amount of time reading tax brackets, phase-out tables, and IRS filing instructions so you do not have to. Today I'm going to walk you through 5 ways the marriage penalty costs two-income couples real money, and what you can do to fight back. Picture a couple sitting at their kitchen table on a Saturday morning. Coffee is getting cold, laptop open. They just plugged their combined income into a tax calculator for the first time since the wedding. The number on the screen is about $4,000 higher than what they paid last year when they filed separately. Nothing changed about their jobs. Nothing changed about their spending. The only thing that changed was a marriage certificate. That couple is not imagining things. According to the Tax Policy Center, roughly 43% of married couples in the United States face some version of this penalty. And it hits hardest when both people earn similar incomes. Federal income tax uses a progressive bracket system. You pay 10% on the first chunk of income, 12% on the next chunk, 22% on the next, and so on, up to 37% at the top. For most of these brackets, the married filing jointly range is exactly double the single filer range. The 12% bracket for a single person ends around $48,000. For a married couple, it ends around $96,000. Double. Fair enough. But the 37% bracket breaks this pattern completely. A single filer does not hit the top bracket until their income crosses roughly $626,000. If the IRS doubled that for married couples, the joint threshold would land around $1,250,000. Instead, the married filing jointly threshold sits at about $751,000. That is roughly $400,000 short of double. So, two people each earning $400,000 a year would sit comfortably in the 35% bracket as single filers. The moment they file jointly, their combined $800,000 pushes past that $751,000 threshold, and some of their income gets taxed at 37%. The Tax Foundation has estimated this gap can create a penalty of filers in added federal taxes on a married couple, compared to what they would owe filing as two single people. And that is only the top bracket. The penalty shows up in smaller, quieter ways across every income level. Take the SALT deduction. State and local tax, or SALT, is one of the biggest deductions available to people who itemize. Under the current rules from the One Big Beautiful Bill Act, you can deduct up to $40,000 in state and local taxes from your federal taxable income. A single filer gets that full $40,000, and a married couple filing jointly gets the exact same $40,000, not $80,000, not double. Two unmarried partners living in the same house, paying the same property taxes, each filing their own return, can deduct twice as much combined as a married couple filing jointly. If you live in a high-tax state like New York, New Jersey, or California, this alone can cost you thousands. And that $40,000 cap starts to shrink once your modified adjusted gross income crosses $500,000. It phases down to $10,000. For a two-income couple hitting that threshold, the deduction advantage of staying unmarried is even bigger. The Earned Income Tax Credit is where the penalty gets cruel. The EITC is designed to help lower-income working people. If you are a single parent, the credit starts phasing out around $23,000 of income. If you are married, that threshold only rises to about $30,000. It does not double. So if two single parents, each earning $20,000, get married, their combined $40,000 pushes them well past the phase-out. They could lose part or all of the credit they were each getting before. For families living close to the line, that difference is groceries and rent. If you are learning something from this breakdown, take a second and subscribe. I make videos like this every week breaking down the parts of the tax code that nobody explains in plain language. Now, there is a flip side that is worth mentioning because the tax code is not equally unfair to everyone. When one spouse earns significantly more than the other, marriage can actually create a tax bonus. The higher earner's income gets spread across wider brackets because the married filing jointly ranges are larger. According to the Tax Policy Center, about 43% of married couples receive a marriage bonus, with the average bonus slightly exceeding the average penalty. The system tends to reward single-earner households and penalize dual-earner households. So the couple where one person makes $200,000 and the other stays home often pays less than two single people earning $100,000 each. The tax code picks winners. So what can you actually do about it? First, maximize your retirement contributions. Both spouses contributing the max to a 401k or similar plan lowers your combined adjusted gross income, which can keep you under phase-out thresholds and in lower brackets. For 2025, the 401k contribution limit sits at $23,500 per person. That is $47,000 in tax-deferred income between two spouses. Second, look at whether married filing separately makes sense for your situation. It is not always better. You lose access to certain credits and deductions when you file separately. But in specific scenarios, especially when one spouse has high medical expenses, significant student loan payments, or income-based repayment plans, filing separately can reduce the overall tax hit. Run the numbers both ways every single year. Third, time your income strategically. If one spouse has a business or freelance income with the flexibility on when revenue gets recognized, shifting income between tax years can keep you below key thresholds. This applies to capital gains too. Selling investments in a year when one spouse has lower income can keep the couple in a lower capital gains bracket. Fourth, if you live in a high-tax state and the SALT cap is eating your deduction, look into whether your state offers a pass-through entity tax. Several states now allow S-corp and partnership owners to pay state income tax at the entity level, which turns a capped SALT deduction into a fully deductible business expense. Not everyone qualifies, but for business owners in states like New York, Connecticut, or California, this can be worth thousands. And fifth, revisit your W-4 withholdings immediately after getting married. The default withholding tables assume your filing status matches your situation, but they are not precise enough to handle two high earners combining incomes. Underpaying throughout the year means an ugly surprise in April. Overpaying means you gave the government an interest-free loan. Neither is what you want. Remember that couple at the kitchen table, staring at a tax bill $4,000 higher than last year? They did not do anything wrong. They just followed the path everyone said to follow: to get a good job, find a partner, get married, and build a life together. The tax code looked at that life and said, "Congratulations, you owe more now." The marriage penalty is not a glitch. It is a structural choice baked into how the United States taxes families. And until that structure changes, the best thing you can do is understand exactly where the traps are so you can plan around them. If you want more breakdowns like this, there are plenty more on the channel. I will see you in the next one.